Welcome to Econ Thoughts, the podcast of the Society of Professional Economists in the UK. I'm Filippo Gaddo, your host, and today I'm very pleased to have as guest Professor Russell Napier, who is the author of the Solid Ground Investment Report and co-founder of the investment research portal ERIC. Russell has worked in the investment business for over 30 years, advising global institutional investors on asset allocation, and he's also the author of the book Anatomy of the Bear, Lessons from Wall Street's Four Great Bottoms. And more recently, in 2021, he published The Asian Financial Crisis, The Birth of the Age of Debt. And Russell is also founded the charitable venture, the Library of Mistakes, which is a business and financial history library in Edinburgh. And we will get, during the show, we'll get to talk a little bit more about that particular venture, which is also quite interesting. It'll be very interesting for all our listeners as well. So Russell, welcome to our show.
Thank you, Filippo.
Russell, we had a few people on the last year on our show talking a little bit about what has happened in the last 15 years and the effect that having zero bound rates and very low interest rates had on the allocation or misallocation of capital and the potential consequences it had on a macroeconomic perspective. Obviously, your book, The Asian Financial Crisis, look at the birth of the age of debt. So we're very good if you could describe a little bit and get into your personal experience as well of the years of your views on economic theory, investment theory around actually the issue of debt in terms of what has happened over the last 30 years. And maybe in the second half of the show, we can talk a little bit more about the outlook. How do you see the investment outlook in the future?
Absolutely. I won't talk about the Asian crisis, but the consequences from it. And where the rubber meets the ground is I think it's created in the developed world, and particularly in America, a disconnect between the growth rate and the discount rate, which is one in economic theory, which is supposed to be dynamic. And I think it's ceased to be dynamic because of this. We keep saying over and over again that central bankers moved in the 1990s to inflation targeting. And of course, it's not true. It is true that many of them did, but it's not true that all of them did. And the People's Bank of China is the standout. Up until 2014, the Bank of Japan was in the same business. Many of the Asian banks got into this post the Asian financial crisis. So we actually set up a global monetary system where some central banks were trying to target inflation while others were trying to target the exchange rate. And the premise of the book and the premise of most of the research I write today is that is a global monetary system. It's a deformed one. It was never agreed. It was, Paul Volcker used to call it the non-system because it wasn't agreed like Bretton Woods. It was enforced. And the net effect of that has been to decouple the discount rate from the growth rate on a quasi-permanent basis. And when capitalists, speculators, arbitrageurs, whatever you want to call them, see that disconnect, they take on more debt. So there's a massive incentive to have the more debt in that world on a belief that it's never going to close, that gap is never going to close. And of course, as a financial historian looking at the history of monetary systems, whether domestic or global, one knows that they don't last forever. But unfortunately, one has to forecast when they come to an end. And for me, it's now. This system does not work for China anymore on a domestic monetary credit system. It doesn't work. It doesn't work geopolitically anymore. It seems kind of silly for China to be linking its currency to a country that often now we would call its enemy. So usually that would take me 90 minutes to explain all of that. Clearly, that's a very brief description of it. But that's the age of debt. That's where it comes from. It's a system that is coming to an end, and that's the crucial thing.
Yeah. And you mentioned obviously the birth of the age of debt, which was more than 20 years ago. And do you see kind of any defining moment between that particular period and now where things either accelerated in terms of ending or took a turn towards ending that particular kind of monetary system?
Yeah, I think if you believe, first of all, in the system I've just outlined, you would have to look at world foreign exchange reserves as an indicator of something. And they go through exponential growth. Certainly by historical standards, you'd call it exponential growth. In other systems that were designed, reserves sort of oscillated around the system and grew gradually, not in this system. That came to an end actually a long time ago in 2014. So since 2014, we've been trying to struggle on, I think, with a different, particularly China. And if you look at 2014, it's when those growth in those reserves end, but it's also when China's debt to GDP really starts to escalate. So I would argue that China's willingness to try and extend the system led them down a road of not producing a lot of money because there was
Mm,
no growth in the central bank balance sheet through the accumulation of foreign exchange reserves, but adding ever more and more non-bank credit, not a non-bank debt, which doesn't create more money. So the escalation of their debt to GDP was really from 2014. So really since then, I think it's a long time, but it's possible to say that this doesn't work for China. And the attempt to try and
mm,
extend and extend and extend it is really getting them into deeper and deeper trouble. The data on debt to GDP is revised fairly significantly from quarter to quarter by the BIS. But in the first quarter of last year, their debt to GDP ratio went up by 6% in a quarter over 3 months. It's kind of astounding.
mm,
So I think it really began to change in 2014. We've been running an empty since 2014, and that's why China has trended towards deflation. Because
mm,
in attempting to do this, attempting to keep the same monetary policy, which is, in my opinion, deeply flawed, it's led them into having too much debt and prone to deflation. And now, of course, since August last year, we have announcements that they may be changing things, but in terms of announcements and action, not
mm.
necessarily the same thing.
Yeah, you haven't seen much actually real action at the moment based on following the announcement they did at the last kind of Congress.
Well, my focus, as you probably gathered from all of this, is on monetary policy, money and
Yeah,
credit. I mean, my job is to forecast asset markets, not the economies. So I focus on money and credit. When I look at those trends since August last year, you don't see good
yeah,
trends. In fact, short-term interest rates are the most interesting one. They launched in August last year a bond buying program, which to me was just incredible. How can you target your exchange rate and then increase your reserves based upon what you just fancy having in terms of the supply of commercial bank reserves? But they announced it, they operated it first time
hmm
since 2007, and then they stopped it in January. So the kind of flagship reflation policy, some people would call it QE, but
yeah,
it doesn't have to be called QE. The flagship reflation policy from a monetary perspective failed abysmally. And then as soon as they stopped it, short-term interest rates started going up. Now we had a few spikes on the 7-day repo rate, but it's back down to 2%. But that's
hmm
still roughly where it was when the reflation was announced last August. And trends in bank credit growth, aggregate credit growth, money supply growth, you wouldn't be able to look at a chart of August and say, this is when the great reflation began.
yeah.
So they are focusing on other things, fiscal measures in particular, things to try and stimulate consumption. But as someone who looks at money and credit, I think these are very, very important,
Mm.
and it isn't working yet.
Okay, sure. And you mentioned over there that it doesn't work for China, the current system. Does it work for the US?
The president doesn't think so. That's for sure. I mean, all of America's ills are now being blamed upon its exchange rate regime, which China imposed upon it and others imposed upon it. I mean, it's worth pointing out that this includes Switzerland and Norway and
Yeah.
Saudi Arabia. It's not just China. Indonesia, India, it's not just China. But yeah, he doesn't think, he thinks it overvalues the exchange rate, back to the Triffin dilemma, and wants to do something about it. And now we're all speculating about what can be done about it. I think there's a fundamental problem here. Uh, it does entail, if the president really wants to do something, a revaluation of the renminbi relative to the dollar. And if the initial part of our conversation was correct, this is an economy with already has an overvalued exchange rate, and obviously not on its trade account. I mean, that is absolutely crystal clear, not on its trade account. But in the aggregate external accounts, it would seem that there are more sellers than buyers of renminbi on a daily basis. Now, if you ask, demand, cajole a nation to revalue its exchange rate when it's already struggling to defend it. And that is what seems to be happening in China. You're asking it to go through a deflation. You're asking it to, let's look for some historical parallels. The United Kingdom, 1925. And I think the Chinese are particularly aware of what Japan did in the 1980s in both the Plaza and Louvre Accord, which
hmm
many of us would argue was played a role in the subsequent bubble in Japan, which has been recovering from for a long time. So at the crux of the problem for the president is I cannot see a deal between China and the United States in terms of that currency. I can see other deals with other nations, but not with China. And China has been the cornerstone, the keystone of that global monetary system. So I think the president does want his currency to be more competitive. The Secretary of the Treasury wants it to be more competitive, but I don't see the path open to international cooperation for that, as it was open very briefly, it has to be said, in both Plaza and Louvre.
Yeah, and going back to the Plaza Living Accord, there are obviously monetary accords, monetary system, but it seems that at the moment the focus it might be that has been on tariffs. So to a certain extent, and now some people say, well, the tariffs is all kind of the flip side or the monetary side, and in a sense that the imbalance is on the monetary side, but the action and the level of attention has been on the tariff. So are you saying that the policies around tariffs is essentially to fix a monetary imbalance?
I think we have to remember what Plaza and Louvre were. They were a coordination of each of the key players, central banks and governments,
Yeah.
at the same time. Now, the central bankers were really very reluctant on that. You probably remember this famous video of James Baker, who was Secretary of the Treasury, pushing Paul Volcker to the front of the kind of press conference so he would be more prominent. And the central bankers came to it reluctantly. So, question number one, will the central bankers cooperate? Because they have to, in my opinion, if they want to fix this, it needs a central. So it's not just about trade, it's about central banking. I think it's highly unlikely that the central bankers would want to be co-opted into such an accord. But importantly, it was Japan. Japan was running the surpluses, but Japan recognized it needed to make concessions to the United States of America, or there were going to be problems. Now, the question is China ready to make those concessions? And geopolitically, it's in a radically different position.
Yeah.
Japan was defended by the United States of America. It was exceptionally reliant upon the American market. China is obviously not covered by the American defense umbrella, quite the reverse. So none of the Louvre or Plaza would have been possible without a compliant Japan and central bankers prepared to collaborate and cooperate to, albeit a minimal extent. And those conditions are not there. So tariffs alone are not sufficient.
Yeah. And so but you're not thinking that there is going to be an accord anytime soon?
No, I cannot see an accord between China and America on the key issue, which is the exchange rate between the two countries.
Yeah. And that obviously you're talking about the end of a particular system. And I was just reading a book by Judy Shelton recently, and she advocated to return, maybe not necessarily the old gold standard, but something quasi a gold standard. Do you think that could be in the cards in the future, or it could be an option, or is it kind of at the moment, since you've been living with flexible exchange rate to a certain extent for 50 years, a return to pegged system or something akin to the gold standard or the Bretton Woods is out of options?
Well, the gold standard is the least likely option.
Yeah.
We have excessively high global debt to GDP ratios in the developed world. This is a time when they want as much monetary flexibility as possible to inflate those debts away. There are other ways to get down your debts in an Austrian fashion, but they're not politically acceptable, and we're not going to approach that. So if suddenly the world was run by Austrian economists, gold standard might be on its way back, but it's run by democratically elected politicians. Now, the next question is, can we have something looser? Under the Bretton Woods Agreement, debts were inflated away. Worth remembering this, that the excessively high debt to GDP levels particularly of Europe post-World War II, were indeed inflated away. So we had a system where currencies were linked and debts were inflated away. But, and it's a big but, it was a system with capital controls. And it was a system that could not have operated with the free movement of capital. So let's take a step back. The problem for me is there couldn't be one monetary system. I can't see how China can be in it. I just cannot see how that can work. So we are talking about perhaps in due course trying to put together another system, a different system with China outside it and China's allies outside it. And then we can begin to talk about some of these issues. But at the core of that has to be allowing each member to inflate away its debts, given where debt to GDP ratio is. And there are many countries with much, much higher levels than the United States of America. So we're probably two steps ahead here, because usually it's a crisis that comes first, which brings everybody to the negotiating table. And maybe in a couple of years from now, we are sitting down at that negotiating table trying to rebuild a global monetary system ex-China, probably around the United States dollar, with inherent ability to inflate away debts. But for me, and I kind of mentioned it already, the key problem there is I cannot see how it can be a system that allows the complete free movement of capital if it's to meet its ends of allowing governments to inflate away their debts, not just their debts, but the debts of the private sector.
Yeah. So, and this is an interesting comment about the free movement of capital, because there was a kind of a investor conference recently, and they mention about potential trade barriers and coming in and therefore kind of adding to uncertainty and potentially kind of not stopping, but slowing down or pushing to the right some investments. And somebody made a comment about capital movement as well. And they said, well, maybe at some point, President Trump might decide actually to put some capital kind of restriction and some or tariffs or some sort of increase in controls. Do you see that as part of the kind of the policy kind of tools that the president might use in the future?
Well, let's start with what's happening at the minute. At the minute, lots of countries are demanding their money back. Now, that's not what they say, but so let's talk about Emmanuel Macron of April last year saying it is absurd that Europe invests 300 billion a year in America. Followed up by Enrico Letta, who from the Institute of Jacques Delors, who said that whatever they put tariffs on, we want to bring our capital back. The United Kingdom's built a British growth fund, which has almost certainly been funded by liquidating overseas assets and particularly US assets. We could get to the extreme form. I think we do get to the extreme form where Europe would say mandate that the tax benefits of a pension wrapper are only available to funds that have a certain percentage invested in European assets or even domestic country assets, which raises other challenges for a single currency. Now, the question really is then how does Trump respond to that? So we look at the numbers. Foreigners own 64.5 trillion of US assets, according to the net international investment position. 51 and a half, or 60, so that's 61 and a half. 54.5 trillion is owned by the foreign private sector. So these are big sums of money. They're not all in liquid assets. Often they're in subsidiaries, fully owned subsidiaries in America. His current account deficit is roughly $1 trillion, and Americans export $1 trillion. Now, those numbers are what I call the soft underbelly of American exceptionalism. And we could speculate as to what happens if Europe mandates a liquidation, effectively, of treasuries by mandating heavier investment in German bonds, for instance. There's a supply of those is about to go up. Once again, we're probably 2 steps ahead. But Trump seems to be a man who doesn't take kindly to this sort of thing and may well come up with some retaliatory measures. But it's quite clear that his weakness is capital outflow. How he responds to capital outflow, whether it's through the choice of you and I as savers or because we're mandated to invest in French government bonds or German government bonds, I think there is a chance that he tries to do something to restrict that capital outflow. He's totally reliant on foreign capital. I mean, let me give you a number. So 33% of the treasury market is owned by foreigners, 40% of the corporate bond market is owned by foreigners, 17% of the equity market is owned by foreigners. So there's a vulnerability there, and this president doesn't like vulnerability.
Yeah, but and I'm not saying kind of, is he aware of that vulnerability? Is he kind of in the top of his mind at the moment, or is he distracted by other things?
I think he may have become aware of it in the last couple of weeks.
Yeah.
And the thing that makes, we discovered this in the United Kingdom in a rather spectacular fashion. The thing that makes politicians very aware of this is the bond market.
Yeah.
So at this point in time, I would say bond yields are pretty sticky given the fall in the rate of inflation in America. It's interesting that yesterday the Fed discussed lower growth, but not lower inflation, obviously because tariffs are coming in. So I think it would be bond yields that would really bring this to the attention of the president if they begin to either stay up as inflation comes down or actually rise as inflation comes down, or at least inflation in the monetary inflation comes down. The tariff inflation, I think, would be going up.
Yeah, no, that's true, because when we're debating at the beginning of the current administration a couple of months ago, people were saying, well, the equity, the stock market might actually potentially mitigate or at least kind of restrain President Trump in some of his action. But it looks like they seem at the moment to be willing actually to write down the stock market because it's going down. And even Secretary kind of Treasury Bessent said, well, it's okay, it's an adjustment, it's fine. But then the next question is, but maybe the bond market actually will make more of an impression, as you correctly say. It is still relatively low. I mean, low compared to what they could have been because they went close to 5 and now they've fallen down. But your point is they start rising again. That's probably where kind of it will start bringing the attention and maybe potentially change direction of policy.
There's 2 issues. One, they start rising again for sure, but there's a ratchet effect here. Interest expense is not the same as interest rate, as you know, as debt matures and is refinanced. So there's a ratcheting effect on total interest expense for the United States government. There's also a ratchet effect on the private sector as well. I think most people very wisely, corporates, went out, borrowed long during the period of exceptionally low rates, and where that's coming home to roost. So even if rates just stay where they are, this ratcheting effect goes up. It has to be said, America is not the most vulnerable country in the world to that. There are other countries with much, much higher private sector debt service ratios, for instance. One thinks of France. But even the status quo is a ratcheting negative effect on the government finances, but also the finances of the corporation.
Yeah, definitely. And I think if I remember well, is during the Biden administration, they did not actually the government did not actually go out for very long. So they got relatively short maturity, which means that, as you say, that ratchet might come relatively quickly.
Yeah. Yeah. So even the status quo, particularly if growth is going down and tax receipts are not growing strongly, that ratcheting effect really, in terms of your bond issuance, can get out of control pretty quickly.
Yeah. So when do you expect a kind of a moment in the next kind of 12, 24 months where there might be a sudden spike, all because one of the kind of treasury auction doesn't go very well and suddenly the market is getting a bit of a panic? Is a little bit of a catalyst happening potentially?
Yeah, I mean, I want to really, really stress that this is not just about America. That catalyst could come in Japan. That catalyst could come in France. The interesting thing is, what would be the response of France and Japan to a spike? Well, it probably withdrawing more capital from America.
Yeah.
And
Yeah,
probably forcing their savers to bring it out of America. So I'm not saying that it's necessarily going to start in America, but generally speaking, developed world nations with high levels of government debt to GDP will not see their bond yields trend lower as their growth trends lower. And that is where they get into trouble. And if we get a spike, then you get a rapid reaction. And if it's more this kind of ratcheting effect, it's a slower reaction. But I think the entire developed world is really going to find itself in that situation. It's very difficult to find an exception. And the issuance of German bonds, bonds in such volume exacerbates the situation because we know, and we kind of alluded to it earlier, how much German savings has spilled out all over the world in a period of low rates of interest. I actually looked and compared the net international investment position in portfolio assets of Germany and Japan, and Germany is now bigger than Japan. This has been a product of those very low rates. We always thought Japan was the big net provider. And Germany's a big gross provider and a big net provider. And now that there's a big bond issuance coming, that could provide the spike, maybe not in Japanese yields, but French yields or US yields could be Germans liquidating their savings to fund the bond issuance.
Yeah. And you mentioned obviously the capital being pulled out by the United States and potentially going into Europe. Will that kind of help and will it be a positive effect on Europe in terms of Letter and also Draghi report? They all talk about the capital market union and getting more Europeans spending more and investing more in Europe. Will we see that and it will be a positive effect? Will it facilitate potentially taking the action that both those report and those ex-Italian prime minister kind of suggested?
Yeah, so I really don't have any doubt that the Draghi plan will be done. It's $1 trillion of investment, and I think it will be done. I've said that since the day it was published. Because I'm not an economist forecasting the economy, but forecasting financial markets, I think the most interesting and fascinating point about that is how much of it is done at the supranational level, i.e. by issuance by the Commission, and how much at the local level. So today we're all focused on the 150 billion issue at the Commission level, which is going to finance defence. But actually, that's a small fraction of what's coming. So the issue for Europe is a fascinating one. We are in a crisis again. And as you know, Jean Monnet said that Europe would be forged in crisis. And for him, Europe and the European Union were the same thing. But what it looks to me like is each nation is really going to be funding its own. I mean, even Merz has said that each nation's fiscal constraints should be widened. What is a Europe like where there isn't where fiscal policy is more and more devolved? Clearly, that's what Maloney would want. It's obviously what Orban would want, the government of the Netherlands would want. We don't know about the government of France. It tends to swing around depending on what coalitions are put together. But it looks to me that despite the 150 billion issuance coming from the Commission, that we've reached that moment where we are decentralizing power within the European Union. Then we go back to the speech. I'm amazed that no one has really paid any attention to Macron's speech of April last year, because he also said that we needed to lift up the inflation target of the ECB. That if you're going to do the Draghi plan, it's initially inherently very inflationary. Now, in the long run, hopefully, it increases capacity, and we're beginning to break the ties that bind off a single currency, certainly fiscal, even potentially monetary. And one final point on that, if each nation state decides to use its own banking system to fund any of this, then that nation state is in the business of creating euros. What we're supposed to have is a central bank which controls through all the various mechanisms, interest rates, capital adequacy ratios, liquidity ratios, the growth in bank credit, and the growth of euro creation. But if the Italians, for instance, start using their banking system to fund defense, and we get an accelerated growth in bank credit in Italy, then central monetary discipline is breaking down as well. So if you're forecasting growth rates for Europe, you probably come up with a good number from all of this. But the inherent problem behind it is this disintegration, which should lead to higher bond premiums for places like France and Italy. So I don't buy into this as someone who focuses on financial markets as an inherently overwhelmingly good thing for the economy, because it's bringing us this moment of truth for the centralization, and it's beginning to break down. And I could be wrong on that, if it's a 400 billion from the Commission or 500 billion from the Commission. But everything I've heard from Merz so far is that they are as opposed to issuance at the central level as they've ever been. And 150 billion is a lot of money, but it's not a lot in the context of the 1 trillion that is possibly to come now to back the Draghi plan.
Yeah, but will that not provide potentially some reaction from the ECB in first place, the Monetary Authority of Europe, but also it kind of not destroys, but it damages and undermines the inflation, the reputation for controlling inflation at the European level, because one of the issues around, and one of the reasons for actually the European Union to a certain extent, but also definitely the euro, was actually to keep control on debt and also on inflation. And it has been successful to the point that maybe inflation was almost too low to a certain extent. But if you get decentralized again and each country decide then to kind of fund it out of their budget, suddenly you lose a little bit of inflation, and then the expectation might be that we're going back to the 60s and the 70s, where actually each country was inflating and then devaluing. I'm talking particularly from the Italian experience. And that kind of leads a little bit of a breakdown of the system.
That's exactly where I think we're going to. There is an answer to that question, and it is the one we've already discussed in the context of the United States of America. I think the action of France or Italy would be to force its domestic savings institutions to buy government bonds and keep those yields low. If we suddenly get a large premium building up in Italy or France in terms of government bond spreads over bonds, that's where you go. So financial repression is the obvious answer. No, it's not. It doesn't mean you're getting any more. In fact, it's actually prolonging the ability to have this devolution of fiscal and I think also monetary power, prolongs it. But it doesn't solve the problem. It just means you get away with it for that bit longer. And I think that is the first port of call. But when we look at, we discussed America and its net international investment position, this huge net deficit it has. I mentioned the gross numbers. The net number is about minus 23 trillion. But if you look at portfolio balances and net deficits and look around the world relative to GDP to see who's the most vulnerable in a world where everybody brings their portfolio balances back to buy Italian government bonds, to buy German government bonds, actually it's France. And that's a fundamental transformation over the last 15 years, that France has now moved into this very large net international investment deficit, particularly on the portfolio account. Portfolio account's about 40% of GDP negative. So in that world where we discuss this retaliation, if you like, capital coming back to home base, there are strains within Europe. I mean, I think that's one of the reasons that President Macron quite wisely wants to do this all at the Commission level, because if they start doing it at the national level, you'll find that a lot of Italians, a lot of Germans are selling French government bonds to finance what has to be financed in Italy and Germany. So there are lots of strains within the system. But one of the 4 freedoms is the free movement of capital. And I do wonder to what extent the free movement of capital in reality, in de jure or de facto or de jure, can be very different. I'm not sure that we're going to have the free movement of capital across Europe. Already been suspended twice, suspended in Cyprus and Greece, and then obviously those restrictions were lifted. So that's the challenge for Europe in this world where Merz doesn't, that's the big issue. It's not Trump. The big issue is Merz and Germany. Does Germany now sort of say the whole of Europe has to act together, or is Germany going to go it alone? I think in the fiscal policy, as I see proposed, it's Germans issuing German debt to mobilize German savings to fund German investment. Now that's a big deal, and Europe's not really seen it like that before, because they've had that fiscal null zero policy, and now that they're opening up, it seems to be it's not run through the Commission.
Yeah, and it sounds that from what you described, that you almost have 2 different forces. There is not a disintegration, but a kind of devolution or kind of decentralization force. At the same time, at least if you read the news potentially, is that there is a force to integration more, particularly on the defense side, in terms of picking up the role, the slack that the United States might leave with regard to Ukraine, but also in defense. So you also see that from a geopolitical point of view, you see potentially Europe coming more together, but from what you described, from a financial and monetary system is probably kind of decentralized. So you almost have two kind of conflicting forces. Is that, first of all, is that kind of interpretation right? And which of the two forces actually would win in the end?
Well, that is correct. And the second force wins because remember, the Draghi plan wasn't really so much about defense. I can't remember the fourth. I mean, and even if you look at Mertz's plan, there's a 500 billion issuance for infrastructure, admittedly over a longer period of time. So this is much, much more than just defense. I mean, we're talking about a Europe which has for some time been trying to decouple from China. And I don't see that trend changing despite this recent problem with Trump. And now I think, and the French president's always been keen on this, a bit more decoupling from America. And then the question is, if you do all that decoupling, it's just not about defense. It's about so much more than defense. And then the question is, would Germany allow the savings of the German people to be mobilized through the Commission to subsidize Italian corporations to build stuff that isn't made in China? I'm skeptical. I don't think that's going to happen. I think that's why the talk of the savings union has never happened. And I think that Merz in particular is going to endorse that. So the problem is that the second one far outweighs the first one because we've got so many other things, and also net zero is in that basket that Draghi wants. So I've got a fairly clear view that more I mean, I use the word devolution, not disintegration as well. I think that's a better phrase. But I think net you get a devolution, even though you get greater cooperation on defense.
Okay, sure, thank you. And the last point that is related to kind of going forward as well. You mentioned a little bit about kind of potential, any positive outlook. Which country, which area do you think currently, I'm not saying he's getting it right, but he has a slightly more positive outlook? And it doesn't have to be in Europe or United States. It could be kind of in Argentina. So which country at the moment you see, okay, they are starting getting actually the policy right?
Well, I'll amaze everybody by saying the United Kingdom. So the international basket case. But the United Kingdom had a constitutional crisis and is through that. And what we're discussing here about these forces, well, we can see it in America. There's a constitutional crisis, Ben, right in front of us. Does the president have the power to do the things he thinks he does? And the courts will have to decide that. At some stage, Congress might even get out of bed and decide that they have. So it's living through a constitutional crisis. There are constitutional crises pretty evident in some nation states in Europe. And if I'm right, it gets kind of bigger now as we fight for whether the Commission really has the power to do what the Commission wants to do and loses that. So the United Kingdom has this, and having left the European Union, it's massively devolved. This is the most devolved political power this country's ever had. It's quite stunning because obviously we have the parliaments in Northern Ireland, in Scotland, in Wales. We now have mayors. So we're devolving political power. I think as a citizen of the country, I see that we don't necessarily have the captains of the ship capable of running that power, but as an optimist, that tends to come along. So the United Kingdom is benefiting from capital inflow. It's got a huge queue of highly skilled foreigners who want to come and live here. We have this city called London, which is the last, in my opinion, the last great international city in the world. But I'm being deliberately confrontational here on the United Kingdom, but I think we have to sort of say that it's a bastion of, we've got another 4 years of stability of a centre-left government which perhaps is going through its Mitterrand moment. As you see in the last few weeks, as it's beginning to realize what can and cannot be afforded. So I think we'll attract capital. I think we'll attract people. Current account deficit is always bad for this country, but it's actually remarkably small given what happened with Brexit. But I advise investors. I don't advise on governments on economic growth. And I think if you're doing that, you're really looking at sectors of the economy wherever they are in the world. It'd be very good for me to say to you 3 years ago, I think Germany isn't going to grow. Don't buy shares in Rheinmetall. Well, it would have been the most disastrous advice I'd ever given an investor. So there's really sectors. If you look at the Draghi plan and it's going to be implemented, my goodness, we're going to see the biggest investment boom in tangible assets. There's been a bit of a boom in intangibles. Intangible assets that we've seen really since that period, that period that France calls the Trente Glorieuses. So there are lots of things you can invest in there. Even though we discussed all these problems at the macro level for Europe, there are lots of corporations in Europe that are going to do exceptionally well. After 30 years, the yoke of Chinese competition is being lifted, creating huge opportunities. And it's not bad for blue-collar workers either. This is a blue collar worker boom, actually. It's different issues for middle class and white collar, but potentially posed by AI. So it's easy to look at it as all negative. But actually, for the average guy in the street, I'm not sure that this does look as negative as most people paint it to be. So I just generally say that economic outcomes from all of this will be better for the average man in the street than expected, but for savers, probably not so good.
Yeah. No, it's good actually to be slightly kind of controversial. I like have different opinions. And which sector in particular do you see? You mentioned a few sectors, obviously the kind of the real kind of it's really tangible assets, but any particular asset classes that will benefit the most or will kind of be more kind of growing?
Yeah, so investors should read the Draghi plan and work backwards and say this will be done. So who benefits from that? Now that's a matter of selecting individual stocks and securities and way beyond my pay grade. But that is going to get done. You should think about that. You then need to think we are going to have less Chinese competition. We see that already in electric vehicles in terms of the tariffs that even Europe's prepared to put on China. So you can begin to look at those companies again.
Yeah.
You can look at steel companies, et cetera, et cetera. So you've got those two trends running parallel with each other, and those are the sort of sectors you want to look at.
Yeah, good. In the last kind of couple of minutes of this kind of the conversation, in one of previous guests, we talked a little bit about narratives and sometimes kind of getting the right interpretation of history, the right reading of history, to actually get the right narrative about particular events. Because if you think that something happened, and in that particular conversation, we're talking a little bit about kind of the legacy and the of Coolidge and the Great Depression, and actually the narratives around those periods in terms of that kind of crystallized in people's mind, which might be different from actually what happened in the real world. And so it's important actually to get your history and financial history right. So it'd be good to kind of talk kind of last couple of minutes about kind of your initiative, about kind of the library of mistakes, and about how that might actually help to get a better sense of our financial history.
Absolutely. So the Library of Mistakes is a business and financial history library. Despite the name, that's what it does. And we have one in Edinburgh, we have one in Switzerland, we have one in India. We are opening in Singapore, and the good news is very probably in London. And just a few hurdles to be jumped. So if anybody would like to help us open in London, they should get in touch. The trend in economics was to make it a hard science and mathematical discipline. Now, we've been moving away from that for some time, but not at a great pace, I would argue. And the father of economics didn't believe in that, given that he wrote a whole book called The Theory of Moral Sentiments, which I think was his favorite book, given that's the one he was revising as he was dying. So it's time we started to think about that again. And my point is that when you read financial history, that's what you're doing, because you're not just reading about the theory and numbers. You're reading about psychology, sociology, philosophy, politics, and it just happens that at this moment in history, it is becoming very evident to investors of all hues that politics matters, that sociology matters, because it's the sociology that brought us the politicians that are changing the asset prices. That psychology matters. Certainly, if you're investing in the crypto world, I think it's pretty obvious that psychology matters. So what we do with financial history is begin to get these back onto the agenda. I say that up in Scotland, we like to do distilling, and we're famous for distilling, but when you distill, you have to throw lots of things away. And I feel that economics has thrown too many things away in the distillation down to an equation and numbers. And we're in our own small way trying to move that needle back and get some of these things back in. And the shortcut to it is financial history. I mean, you can go and get a degree in mass psychology, go and get a degree in politics, but the shortcut actually is to read financial history, and that's what we're promoting. That's what we're trying to do. So we have lectures there. They're all live streamed. They're all on video. We also have a podcast on financial history. So that is the missionary work of the charity that runs Library of Mistakes. And let me just finish by saying it's catching because we are also in discussions with Montreal, Toronto, Frankfurt, Barcelona, Madrid, and Mumbai. So other people seem to have come to the conclusion that we need to get beyond that equation as quickly as we possibly can. And this may be just in a small way, this may be one way we can do that.
No, that's fantastic. And I totally agree with you in terms of potentially, not necessarily moving away, but integrating a little bit more than just the numbers. And I'm glad you mentioned the Theory of Moral Sentiment. That's kind of my favorite book of Adam Smith. And in fact, I will go even further. I started reading a little bit about the Salamanca school, and in the 16th century, which actually probably started the theory of economics, and is a very unorthodox kind of a place to look for, but definitely something that people should be more aware of. We'll definitely put the link to Deliberate Mistakes on the show notes as well for all the listeners that might want to get in touch. Russell, it's been an absolute pleasure having you with us. It's been a fascinating conversation. Thank you for your time.
Filippo, thank you very much.